Hello everybody and thank you for joining us. I'm Jill Ford and I'm pleased to welcome you to today's media briefing about the BIS December quarterly review. With me today are Claudio Borio, Head of the Monetary and Economic Department, who is joining us remotely today. Hello Claudio. And Hyun Shin, Economic Advisor and Head of Research, as well as the authors of the special features. Before we begin, I want to reiterate that only comments from Mr. Shin and Mr. Borio are on the record. If we have any questions on the features, author comments are strictly off the record and not for quoting or attribution. The media conference will be recorded and presented on our website and digital channels next week when the embargo lifts. The embargo lifts on Monday, the 4th of December at 1 p.m. So I'll hand over to Mr. Borio and Mr. Shin to give some opening remarks, and then we'll take questions on the QR. Over to you.
Well, thank you. Thank you, Jill, and thanks everyone for joining us today. In this quarterly, we'll review financial market developments from the 9th of September to the 24th of November. During this period, fluctuations reflected investors' attempts to continue to adjust to the higher for longer interest rate environment as central banks vowed to complete the last mile in their fight against inflation. Given market participants' heightened sensitivity to news, financial markets went through two very distinct phases. In the first, through October, investors perceived interest rates to remain high for longer than they had originally anticipated. The mood then shifted markedly in the second, November phase, when market participants interpreted central bank announcements and economic data as suggesting that further hikes were less likely and eventual rate cuts could come sooner. In the background, announcements about sovereign debt issuance also played a role. Bond yields soared in the first phase. Yields on long-term government bonds in major advanced economies reached decade peaks, and in some cases, heights not seen for much longer than that. With the bond market rout giving way to a rally in November, yields retreated, and by the way, now they're roughly back where they were at the beginning of the period. Despite central banks' cautious tone, investors priced in cuts in the euro area and the United States as early as the first half of 2024. Nevertheless, amid the rapid changing conditions, volatility in fixed income markets stayed elevated. Across the two phases, stocks and government bonds moved in the same direction. From a longer-term perspective, this is quite unusual. When it happens, the hedging role of government bonds weakens and the compensation for holding them rises. Fundamentally, the co-movement reflects the inflationary environment we are living in. One of the boxes in the overview looks into this phenomenon more closely. A muted and short-lived market reaction to the outbreak of war in the Middle East generated few, if any, signs of a flight to safety. The evolution of risky asset markets roughly tracked that of fixed income markets. Prices initially fell and then rebounded. The generally benign credit market conditions contrasted with tight bank lending standards in the US and euro area amid rising defaults and funding pressures. Tensions in credit markets may lie ahead. A lot of debt will become due in the next few years and may need to be refinanced at much higher interest rates. A second box documents that small firms are particularly exposed to refinancing needs. If we stand back, we see that the market tensions in March reflected the materialization of interest rate risk. The unfolding of credit risk is largely still to come. Both risks represent the legacy of the very long period of exceptionally low interest rates that we have left behind. A third box in the overview examines the sustained headwinds for life insurance companies. One potential reason is investors' concerns that liquidity needs may force life insurers to recognize, yes, unrecognized losses. Financial conditions in emerging market economies evolved in line with the global environment. In the first phase of the review period, EMEs continued to grapple with high US yields, which reduced investors' appetite for local currency government bonds and led to capital outflows. Some respite came in November, when US long-term yields declined. While Latin American exchange rate mirrored this pattern, first depreciating and then recovering, those in emerging Asia remained stable, in part on the back of FX central bank interventions. Let me now turn to Hyun, who will present the special features of the issue.
Thank you, Claudio. The special features in this quarterly review cover a range of topics: global liquidity, liquidity management by central counterparties, borrowers from money market funds, and buy now, pay later consumer credit, as well as the state of the labour market. In the first special issue, Brian Hardy and Götz von Peter take stock of the changing phases of global liquidity. The first phase was the period of excess leading up to the 2008 Great Financial Crisis. The second phase, in the wake of the GFC, saw bond markets take the lead in channeling global liquidity, especially to emerging market economies. The authors ask whether we have entered a third phase, marked by a reversal of earlier expansionary trends as central banks have been tightening monetary policy to combat inflation. In another special feature, Iñaki Aldasoro, Fernando Avalos, and Wenchan Huang look at the pool of liquid assets held as collateral by central counterparties, or CCPs. They find that CCPs in Europe and the Americas predominantly hold government bonds, whereas those in Asia-Pacific hold mostly deposits at central banks and other short-term claims. The authors explain how shifts in the composition of CCP liquid assets can amplify liquidity shortages in times of stress. In the third special feature, Iñaki Aldasoro and Sebastian Durr dissect the role of money market funds in short-term funding markets, especially in US dollars. They show that during the recent period of monetary policy tightening, MMFs deployed their growing assets to supply liquidity to banks, as well as to build claims backed by government paper. This finding runs counter to the narrative that MMFs shift funding to non-bank financial intermediaries. In the fourth special feature, Giulia Cornelli, Leonardo Gambacota, and Livia Pancotto draw on data covering so-called buy now, pay later schemes. In these schemes, retail consumers pay interest-free installments, while merchants pay fees to platforms in order to increase sales and to shed credit risk. The authors unearth several features of such credit and find that it is more widespread in countries with greater e-commerce penetration, higher inflation, more inefficient banking systems, and looser financial and consumer protection regulation. In the final special feature, Bernardo Stornik, Denise Egan, and Anis Karoubi examine why labour markets remain so tight in many countries. The authors find roles for labour hoarding, demographic trends, and shifting attitudes towards work. They explain how the shifts in the labour market will be an important determinant of inflation.
Thank you both very much for the remarks. And now we turn to your questions. So as usual, you can ask a question in the chat or raise your hand. I'm aware we have a number of people on phones as well, so you can email media@bis.org and we will bring those questions you have into the chat. So I think Mark has a raised hand. Mark Jones from Reuters, over to you.
Hi there.
Hi.
Can you hear me? Great.
We can, yeah.
Good, good. So I guess the kind of macro story, as you were pointing out, Claudio, is that the markets have switched very much. And I know in recent reports you've been saying, you know, the markets have to be ready for higher for longer, but they seem to be actually thinking about softer and faster. I don't know if you've got a view on that and whether maybe markets are getting a bit carried away with themselves.
Well, let me first say that this dialectic between central banks and markets, in a way, it is what we would expect. That is, that each of them is interpreting the income data in the best way possible. I think central banks have clearly said that they are laser focused on bringing inflation down. The latest news has been quite positive. For example, the latest CPI numbers that we have seen recently. So the outlook has improved recently, but the key point, which I think we need to bear in mind, is that we're not out of the woods yet, and that the job has to be done. So central banks are simply pointing out that they're making their forecast about inflation. They're well aware of the risks, and they will keep interest rates up as long as it's needed in order to get inflation down. Then we will see exactly for how long that will have to be.
Thanks very much, Claudio. I see another raised hand from Paul Davies of Bloomberg. Paul, if you want to ask your question, please.
Yeah, hi.
Hi.
I wanted to ask about the money market fund special report, if that's okay.
Yeah, please go ahead.
Yeah, thanks for that. It's a very interesting, really good report. I guess one question I had about it is, how long a period does it cover, especially when you're talking about where the extra AUM goes from money markets? I mean, obviously there was a big change in the structure of the industry after the GFC with near collapse of prime funds, which were much more exposed to kind of corporate borrowers. So I was wondering if there's been a sort of a change over time in where the money goes. And then the second one is a related question, which is about, so the Federal Reserve and the Bank of England, maybe others now have these standing repo facilities, which are supposed to put a cap on repo rates if there's kind of liquidity issues in repo markets from the banking system. And I think they see that as a defense against problems arising as QT progresses, quantitative tightening. Do you guys think that those are operationally ready to use? Are there going to be frictions in terms of banks not wanting to act as conduits for that repo liquidity? Or is there going to be the rise in the use of the FICC that you note in the money market fund report? Is that something that might get in the way of these standing repo facilities functioning well? Sorry, that was quite a lot.
No problem. That's it. Two for the price of one. Just looking at Hyun in the room, do you want to kick off and then we pass over to Claudio? Okay.
Yeah.
Thank you.
Yeah. So Paul, those are very good questions, and we can certainly put you in touch with the authors so that you have a much more in-depth discussion with the authors on the finer points. I mean, the data period actually, if you look at the charts in the special feature, they extend back. In some of the charts, they go all the way back to 1990, but the period that we have in mind in particular is the post-GFC period. As you say, the GFC was was a catalyst for a rethink on the money market funds. And in fact, the money market fund reforms that you referred to, they came in somewhat later. They kicked in 2016, and the big changes happened in the last several years. The point that we want to that the authors are making in this special feature, and they use very good microdata to actually sort of delve into some of the details, is that contrary to this narrative that we've come across, especially after the banking stress in March, that somehow money market funds are diverting funds away from banks. If you look at the assets that are held by money market funds, in fact, they're actually channeling a lot of funding back into the banking sector. And the other aspect, as you note, is the growing role of repos backed by government paper that are also being financed by money market funds. And this is, of course, a feature that is very closely related to the new monetary policy operating framework, where we have a floor. There are actually some very important policy issues, as you point out. So rather than sort of hogging the time here, what we'll do is put you in touch with the authors so that you can explore some of the more detailed questions with them.
Yeah, that'd be great. Thank you.
Yeah.
And Claudio, do you want to take the second?
No. Well, actually, Hyun has already sort of mentioned that, so
Okay.
I think the authors can provide more details. Just let me say that I think those facilities are important. They are operationally effective. And they're important because as the liquidity or bank reserves are withdrawn from the system, it's the point at which there could be some tensions in the money markets is unclear. And so it's important to have some backstops that will make sure that things do not get out of hand.
Next question, and a hand raised from Elena Bronzanti. And Elena is from Estado. Elena, please ask your question.
Okay, thank you for accepting my question. How do you see the central banks trying to use their speech to keep the financial conditions tight, sharing with the market the part of the tightening work? What are the main challenges for the monetary policies next year? How do you see the Fed's action in 2024? How does this scenario impact emerging markets, especially Brazil, that started the cutting rates earlier? Thank you.
Thanks. I don't think we want to give forward guidance on the particular policy, but maybe on particular countries. But Claudio, could I hand over to you for this one?
Sure. Well, I mean, there are no specific challenges I would say that the central banks are facing at the current juncture. They're just continuing the fight against inflation. We had an early phase in which it was clear what they had to do. They had to raise interest rates quite rapidly and persistently, because partly because inflation came as a surprise, and so they had to catch up. Now we are at a stage in which, as we said earlier, inflation is coming down. Some of that has been the result of some of the one-off things like base effects or the unwinding of problems in global supply chains, the fall in commodity prices. Some of that reflects the fact that monetary policy, aggregate demand has been weakening, and monetary policy is playing a role. Now, looking forward, the challenge that central banks have is basically to decide what to do next, given that the evolution of inflation is, as always, uncertain. So the direction of interest rates is less clear than it was during the phase in which they had to tighten. And they will see. I think, as I mentioned earlier, it's very important for them to remain laser focused on inflation, and to remain also flexible and nimble and adjust to the changing circumstances, monetary policy being data dependent. Now, looking at, in terms of the implications of emerging market economies, as we saw, emerging market economies have done pretty well, have managed to hold up as interest rates have increased in Latin America for the reasons that you mentioned. They took preemptive action, which has clearly stood them in good stead. Going forward, obviously the environment will become less welcoming if interest rate has to stay up or had to go up again for unexpected reasons. But I think they're well equipped to deal with those issues.
Thank you. Hyun, do you want to come in before we finish?
Yes, perhaps what I could add, Alina, is that emerging markets, let me just underline the fact that emerging markets have done quite well during the recent episode of monetary tightening in advanced economies. It's partly down to the fact that they were tightening preemptively. If you look at the charts, especially in the overview, what you see is that they had already started tightening, especially in Latin America, tightening already in 2021, well in advance of the advanced economies. Part of the reason why they have managed to cut more recently is because that they had already tightened quite substantially, and they were in a very good position to then respond to changing conditions. The other aspect, which I think is very notable, is that exchange rates have remained very stable and actually quite strong, and much stronger than we would normally expect for emerging markets during a period of very rapid monetary tightening in the advanced economies. And I think, as you may have seen, we put out a bulletin a couple of weeks ago, just underlining how important that experience is, and drawing some lessons on how emerging markets should conduct monetary policy in the face of tighter conditions.
Thank you.
Thank you very much. I'll go to a question now from Politico, from Carlo Buffa. He is asking in particular, and again, he's asking about the ECB, so I think we don't need to be very broad in terms of our answer, but he said the financing costs for sovereigns will rise next year when many of them will have to refinance debt at higher costs in the Eurozone. So he's asking, do you see scope for the ECB to activate its TPI next year? But maybe we could answer that more broadly, Claudio.
Yeah, sure. Yes, indeed. I don't want to speculate about the room for maneuver for the ECB in that context and what the ECB might do. I will just mention, and allow me, if I may, to take a longer term perspective, that in the annual economic report that came out in June, you may have seen that we highlighted the debt trajectory of the government debt trajectory going forward over the medium longer term as being probably one of the toughest challenges that the world economy is going to face, and also central banks will have to face, because it's not on a longer term sustainable basis, and measures will have to be taken. We are starting from a very difficult position. Government debt to GDP ratios are historically high. They were already historically high before COVID. They were roughly in line with, or they are roughly in line with what they were during the Second World War. And here I'm talking, broadly speaking, about an averages, if you like, across the world. And the burst of inflation has only provided a short-term relief. So looking forward, clearly some adjustments will have to be made in order to make sure that the fiscal policy has sufficient buffers or safety margins to deal with the expected and the unexpected. But first of all, in order to actually help in reestablishing or making sure that we are going to move along a sustainable trajectory for the global macroeconomy.
There's there's actually three questions in on BNPL. So what I'd suggest is I go through them, and then maybe if we want, we can offer an author briefing as a follow-up here as well. So the questions are from both Tim Wallace of the Daily Telegraph and Isaac Hansen from Retail Banker. So Tim is asking, in the first instance, how worried should we be about the spread of BNPL? It is often correlated with weak consumer protection regulation. Is this a risk to either consumer finance or the wider financial system? Okay, yeah.
So maybe I can take that, Jill. Thanks for that question. I think we can definitely arrange an author briefing on that. If we just go through the list that you've just mentioned, certainly on the wider financial system, what's really quite interesting about these schemes is that if we look at the funding of these firms, it's not debt as we might typically expect. So, you know, we might think that these firms actually fund themselves by issuing bonds or borrowing from other lenders. But actually, it turns out that they finance themselves a lot with equity, and you know, it can come either from venture capital firms or from other large investors. And to the extent that these firms are actually financed mostly by equity, the losses are not going to have the same kind of ripple effects through the economy as would be the case if these firms were funded by debt. To some extent, we can think of the prevalence of these buy now, pay later schemes as a reflection of the very low interest rates that we saw, especially during the pandemic, when we also had a big surge in e-commerce. So that combination of low rates and a big boost in e-commerce clearly was, a factor behind the rapid rise in these, in these schemes. Now, it remains to be seen how well they will do in this much more challenging environment. And I think it would be, reasonable to conjecture that, once you don't have this particular very favorable combination, that they would, not do as well. Now, in terms of consumer protection, this is a new area. I think this will be certainly one, element that we will need to watch very closely. And definitely, we can arrange a briefing with the authors for you.
Right, thanks. And there's a second question, which I'll read in, but I think we don't have the data. Isaac Hansen is asking from Retail Banker, do we have data on whether consumers are keeping up with repayments at rates comparable to other consumer credit products? And I'm not sure that we do. But
yeah, thank you for that question. I think, that's exactly the kind of question we should be asking. Now, unfortunately, we don't have that data. For the US, this CFPB, the Consumer Financial Protection Board, do have some aggregate data, but just for US borrowers. But there is a time lag in the publication. So one of the things that we would have very much liked to do, but couldn't, was because of the lack of data.
If I may just add a couple of things to what Hyun said, in terms of a few facts that are highlighted in the special feature. First of all, these platforms have been making losses, and so we should bear that in mind. Hyun rightly said that the environment is becoming more hostile to their business model, so they are facing challenges ahead. The second point is the question about financial stability. No, they do not pose financial stability risks. We don't think so for the system as a whole. Of course, they're likely to be, given that what I mentioned earlier, the fact that we have seen the materialization of interest rate risk, we have not yet seen much of the materialization of credit risk. They're likely to be losses, and those that borrowed are likely to default, and some of them are likely to default. And here, the other important point, which is mentioned in the note, based on limited data, is that the record, those who borrow from these in this form tend to be some of the more risky customers, and that their record is probably, it's not as good as that of other borrowers, and that's done by comparing borrowers that borrow in this form and other forms, and those that do not borrow in this form. And typically, the default record is worse for those that also borrow in this form.
Thank you, Claudio. I see another raised hand from Vanya Damyanova from SMB Global Market Intelligence. Vanya, if you want to ask your question, please.
Thanks very much. So my question was again on the special feature by now pay later, but most of it was answered. I was just going to add a little bit of you are looking at several regions in the report. Are any of those concerns higher for any of the regions included? So basically, do you see kind of like more concern on systemic risk or indirect links that can cause some risk to the system in any of the countries based on how big the sector is?
Yes, thank you for that question. I think if you, I mean, there are some charts in the special feature, and I would just refer you to those. These platforms are still relatively small. Comparatively speaking, as a total of the aggregate. So I think systemic risk is probably not the would not be uppermost. I think when we consider them, let me just repeat the point earlier that if you look at how these platforms are funded, venture capital really is the lion's share. So they're mostly equity finance. Now, of course, there are other investors who invest in those venture capital firms, and as you see there, pension funds, endowments, and other private wealth management firms. I mean, they are, investors in those venture capital firms themselves. But this is not the kind of, domino nature of debt that where you have A borrowing from B and B borrowing from C and so on, of the type that we saw in the GFC. So this is not really the same type of situation where we have this daisy chain of debt.
Thanks very much, Hyun. So I don't see any other hands raised, but I'll give a moment for other hands or other questions coming through in the chat. We'll just pause for a moment in case anyone wants to raise a hand or type a question in. Considering there are some people on the phones, I'll just pause for a moment to enable them to type. Thanks everyone for your patience. Just checking the emails. Okay, I don't think we have any further questions in that case. Oh, we have a raised hand just as I was about to sign it off. Tim Wallace from The Telegraph, do you want to come in with a question?
Hello, yes, I wanted to ask as well about the labour markets. You mentioned shifting preferences among workers. Can you go into a bit more detail about that? Because a lot of what gets talked about is preference, so different working patterns, preference for working remotely or working in a hybrid fashion. Is it also, your report also indicates an overall reduction in working hours? What's prompted that, and how sustainable do you think that will be as a long-term trend?
Okay, Hyun, over to you. Thank you.
Yeah, let me take that actually. I think this is a topic that's been very well commented by macro commentators, throughout the aftermath of the pandemic. One of the things that we've seen is that the tightness of the labor market has manifested itself through a very high vacancy rate. So in particular, relative to unemployment, we see vacancy rates being very high, and that the open positions have been very high relative to the number of unemployed. And typically we think of that kind of phenomenon where you have very high vacancy rates as a signal of some kind of labor market mismatch, where the openings are somehow not well matched with jobs, with the people who are unemployed, and that was certainly one of the themes that we saw during the GFC and its aftermath, where we had a shift away from the real estate sector. This time around, that doesn't apply as strongly, because the people who were laid off, people who reduced their hours, were in the most contact, intensive sectors, hospitality, services related to to hospitality and lodgings and so on. And that's where the employment really came roaring back fastest. And yet vacancy rates, have remained very high until very recently, and they're still very high relative to historical standards. So I think, we have to look elsewhere for why labor markets, have been so tight and why, vacancy rates have been very high. And I think one of the things that, there are a couple of issues. One is as the authors say, there's been this apparent sort of, change in the attitude towards work, and the way that, we think about work in the labor market. And the second is the sort of greater the early retirement of the people who are close to retirement, and those people really haven't come back as much as we may have expected. And so there are these longer term structural issues, possibly due to the shock imparted by the pandemic itself. But certainly these are much longer term issues rather than simply the ups and downs of the business cycle and the business cycle frequency in monetary and fiscal policy. So it's definitely worth keeping an eye on.
Thank you very much, Hyun. I think you've probably adequately answered that, unless, Claudio, you want to add anything else? No, you're okay. Okay, so I don't see any other hands raised or questions in the chat. Thank you very much, everybody, for your time. All the materials are now available on the embargo pages. A reminder that it lifts at 1 p.m. Central European time on Monday, the 4th of December. So thank you very much, everybody. Sorry, there's another question. Technically coming in after the goodbye, but let's just see. The question is, I can't see the question coming in. Sorry. It's a CCP question. Just came in on email. Okay. I think it's from Greg Ritchie, if I'm correct. On the liquid assets at CCPs and systemic liquidity risks paper, what would we like to see from global policymakers to mitigate the potential for margin spirals and wrong way risk? Does the makeup of CCP collateral or setting CCP margining policies need to change? So last question from Greg Ritchie.
Yeah, I think I can take that. Let me
please.
take that, Jill. So that's a very, thank you for that question, which I think is a very important question. And as you might expect, this is a question that's been has been uppermost in the policymakers, in this area. The CPMI, the Committee on Payments and Market Infrastructures, and it's the market infrastructure aspect, has of course been working very hard on this. There are several reports that the CPMI has published together with IOSCO, which is the umbrella organization for the securities regulators, on issues such as margining practices, some of the pro-cyclical aspects of margining. And, we can point you to some of these publications. We'll just, give you the links to 2 or 3 of the most important ones. I think those lessons are ones that, you would expect, and, ones that would, certainly, resonate with people who have looked at financial stability issues. One is the importance of transparency, and the other is, ways of mitigating some of the margin procyclicality. And that's, those lessons have very much been taken on board, and we'll send you the links to those reports. This special feature is on a slightly sort of narrower question of how the cash reserves are held within CCPs, and there the topic has to do with how the type of collateral being held might interact with market dynamics. So in particular, if you're holding government bonds, but then you need to sell some of those bonds, how much will that affect the the value of that collateral, and so on. So it's a slightly narrower topic, but of course, we've published a lot on margin procyclicality and the overall impact on financial markets. And I think we can, we'll send you the link to a bulletin that we published a couple of months ago, which is probably the best source for this.
Great, thanks very much. So we'll get back to you on that. So now I think we are closed. Final question. Thanks for getting in there with your quick typing, Greg. Okay, so just a reminder that the embargo lifts at 1 p.m. Central European time on Monday, the 4th of December. Thank you very much, everybody, for your time, and we'll see you again in the new year.